Francisco, I feel like the market today, let's talk about oil, is faced with two things. And one, very, very, very strong imports into China on the copper side, on the oil side, and the iron ore side. And then the flip side, continued potential shutdowns here in the U.S., and then potentially weaker gasoline demand and refinery utilization. How do you understand these two different narratives?
Well, look, Alex, I think one of the biggest scars we're going to have from COVID-19, it seems, is that the gap between the U.S. and the Chinese economies in terms of GDP size is going to close at a faster rate, which is a major geopolitical shift, but also has huge implications for the commodity markets. Now, China, to be fair, is doing a lot better than the majority of emerging markets in terms of controlling the virus. So if you look at other emerging markets like Brazil or Chile or Peru, they're not doing nearly as well as China. In fact, they're doing pretty poorly. Mexico as well in terms of controlling the outbreak. So we are having essentially, as a result, disruptions on the mining side, which are supporting some of the industrial commodities. And then in China, we just see the economy doing pretty well. So consumption is up, and as a result, we're seeing a big run up in the kind of industrial commodity front. Oil is a bit of a different story. To your point, it's slightly different story.
So let's focus on oil for just a sec before we get to things like copper and iron ore. For oil, it's confusing and it's conflicting. And then you also have an OPEC meeting tomorrow where they actually have to decide whether or not they're going to roll back the production cuts and increase the amount of oil in the market. How do they do that?
Well, look, at the end of the day, OPEC has been very clear, and I think particularly Russia's position has been very clear. They don't want to lose market share to U.S. shale permanently. So they're not going to be holding back production forever. Demand is coming back, and I realize some of the comments that you just made, like California is rolling back some of the reopening measures. Same thing's happening in Texas and Florida. But the reality of the matter is all the rollbacks in terms of the lockdowns are being quite local. On a global basis, we're still seeing rising consumption. And gasoline, as I've said to you before in this program, is experiencing a V-shaped recovery. Not so much jet fuel, since we were just talking about in the break that I'm not going to be in London for a while, and frankly, I think that many of us are not going to be setting our foot on a plane for some time. I think that jet fuel is going to be an L-shaped recovery. But on aggregate, the majority of demand for oil comes from road transportation. And also remember, demand for plastics is very, very strong. So that's supporting the petrochemical industry. That's supporting demand for ethane, butane, naphthas. So there's also other oils that are seeing strong demand here. So I think OPEC is counting on that recovery and is counting on maybe localized lockdowns as opposed to global. I think what happened in Beijing in the last month is a good example of what we may see on a global basis. But for the most part, the world's really waiting on a vaccine, really waiting on a cure, a treatment for a full recovery, and that's ultimately something that OPEC has to manage as well. So my view is that they'll proceed as planned, and they'll roll back 2 million barrels a day of cuts into the month of August, and they'll have to cope with that. So the last thing OPEC wants is $60 oil overnight and shale coming back immediately. That's I think the last thing they want here.
Francisco, sorry, can I just take you back to that L-shaped recovery in the jet fuel market? How far out does the bottom of the L go? Delta posting numbers today, certainly sounding cautious, particularly about what's happening in the Sun Belt in the United States, which is a big part of their business. As you say, transatlantic's not coming back anytime soon. How long are we talking here?
Well, I think we're going to see, if you look at China, for instance, traffic has recovered to 50% of normal, but in China they have the virus under control. And if you look at Beijing, we almost went back to 0 flights as we had an outbreak there a few weeks ago. So I think probably the best we can hope for is somewhere in the range of 30 to 50% off normal. Assuming that we have some degree of control of the virus, or maybe we just give up on it. I don't know. But I think ultimately, in my opinion, is that the virus is driven both by the lockdowns, but also importantly by human behavior, by fear. So if the death rate goes up, it's not just the government is going to instruct lockdowns, it's that people are not going to go anywhere, right? Because you're going to be afraid that something can happen to you, and fear is a big factor of human behavior. And I think the southern belt of the U.S. didn't quite feel that fear until recently, and they're going to feel it now because, as we've learned in New York City, it's a pretty scary thing. So that I think probably prevents the L. I think it goes out, my view, at least 6 months, maybe 12 months until people deem it safe to be back on a plane. So that's kind of my expectation. 6 to 12 months would be the path I would expect for recovering jet fuel at the very least.
So that's a really good drill down into the demand side, which brings me back to the supply side. And I wonder how much flexibility producers are going to have. So on the one hand, producers in Chile may be not very flexible. So that might be the bull case then for copper. On the flip side, OPEC may be more flexible, which means maybe oil can be managed. How do you see it? And then how does that then inform sort of commodity bets going forward?
So our view is essentially quite clear. We think prices are going to be range bound at these levels over the course of the next few months. Maybe there's a buying opportunity if OPEC brings back more supply, if compliance dips a little bit, and kind of use that as a buying opportunity to position, because eventually at some point next year, once demand recovers from kind of the average level of 90 million barrels a day this year compared to 100 last year, we go back to 98 million barrels a day next year. I think at that level, then you're going to need some shale supply to come back. And for that to happen, you're going to need prices meaningfully higher. The shale industry in the U.S. has taken a huge hit. And the only way to see a recovery in production here, which I think you will need eventually because of the global capex destruction we've seen in the energy sector, is through higher prices. So we do think prices in the second half of next year will hit $60 a barrel for Brent. So we do think that eventually we'll see higher spot prices. On average, we think Brent will be around 50 next year. But that will not materialize until we are heading into the fourth quarter. And there is some clarity in terms of the demand recovery, in my view. So it will take a little bit of time from here on to see stronger price action.